Shall you can pass us the control as well, right? Once we get to the slides. Oh, wonderful.
Yes, can.
Good afternoon, ladies and gentlemen, and welcome to our webinar today on sustainable supply chain financing. My name is Navina, and I represent Capital Markets Malaysia, which is an affiliate of the Securities Commission Malaysia. Today's webinar is being brought to you by the Malaysian Sustainable Finance Initiative, which is a center of excellence under Capital Markets Malaysia. And we are very fortunate to have the support of the ASEAN Low Carbon Energy Program by the UK government and our delivery partner, EY. So today's session is 90 minutes in length. It will start with a presentation by EY, followed by presentations by we have HSBC Amanah, Citi, and EcoVadis presenting. But first of all, I just want to go through a couple of housekeeping details. If you'd like to ask a question at any time during the session, you just need to click the Q&A box at the bottom of your screen and type your question in there. And the presenters will be happy to take them after they've completed their presentations. At the end of the session, there'll be a poll, an exit poll question. So if you could just take a minute to fill out the poll to let us know your feedback on the event, we'd really appreciate it. So without further ado, I'd like to invite our first presenter, Arina Koff, who is Partner of Climate Change and Sustainability Services from EY Malaysia, to deliver her presentation. So Arina, over to you.
Thank you, Navina, and a very good evening to everyone. So first, we'll kickstart with a few context setting. I'm actually going to share on understanding the growth of sustainable supply chain financing to give everyone a good context. Now, we see in the market, there are several forces that is driving, creating the urgency to handle sustainable value chain across various stakeholders. We've seen these are the key 7 market forces. One of the key thing is the regulatory requirements, not just in the local context by Bursa, SC, Bank Negara. We're also seeing mandatory SEC and ISSB climate disclosures currently being put in place in discussion draft, but will be finalized to also look at how sustainable measurements are going to impact enterprise value. Second part is institutional investor scrutiny is definitely on the rise of sustainable investing. We've seen the EPF, QuAB, Khazanah, as well as the likes of the BlackRock and Maybank, CMB are all heavily enhancing their focus when it comes to transitioning from conventional financing to sustainable financing, including sustainable investing. So the third part is we are seeing geopolitical conflict, supply chain disruption, and rising inflation. And this is going to also drive what are the practices within the supply chain that will be critically monitored, as well as the controversies that's happening in the shade of light when digital access of information are becoming increasingly enabled. Number 4 is when it comes to climate change, it is to create, we are seeing new global threats and opportunities from carbon taxonomy, as well as opportunities from new solutions, green technical or green technologies that are disrupting market, and as well as innovation. So the 5th one is really on employee and customer engagements. More and more consumers or prosumers that we see nowadays are really looking at traceability of the services and products that they're obtaining. And number 6 is on racial equity, social justice, and human rights. We've seen even for Malaysia has ratified the ILO, International Labour Ordinance, that actually drive towards ensuring the forced labor are being handled within the supply and value chain. So number 7 is on rapid technology advancements and competition in this time of disruption, as I mentioned. So if we go on to the next slide, why all these are critical and important is also because there are sharper focus on the significant events that has happened when it comes to supply chain management. So we've seen quite a number of evolution of supply chain resilience over the past decades, and we've seen a number of key scandals that have happened since Deepwater Horizon oil spill up to the collapse of Rana Plaza in Bangladesh, which have killed over 1,000 employees and injured over 2,500 people, to where we've seen there are still a lot of French laws, as well as a number of China plans on carbon reduction target, to today's IPCC Code Rate for Humanity, that has I think there's some background noise.
Few years, but I ran a passion project of mine.
Maybe
So
we
it was for my
can.
friends.
Okay.
Okay,
Thank you.
I muted.
No, thank you.
Solo. Yeah.
So in terms of the disturbance or what we are seeing in supply chain, the challenges or the significant events that has happened in supply chain, it has pushed quite a number of efforts on sustainable management. Now we are seeing key issues such as fragile cost, optimized linear supply chains, and excessive supply concentration risk. Now the implications for business is really the trade barriers, the shortage of raw materials, causing the surge in cost, replacements, sustainable sources of supply, and materials with high GHG impact. Now we are seeing costs will be impacted by carbon taxonomies, and on the other part is ongoing shipping disruption, how these are also going to disrupt some of the shipping methods with the emissions consideration. We have seen in a number of sectors like agriculture, manufacturing, the poor visibility, resilience, and agility when it comes to ensuring what are the end-to-end processes of traceability, reputational damage, for example, the Uyghur bill that has also been heavily discussed. And also when it comes to the inflation cost pressures, what are the increased procurement costs that is causing the erosion of margin, leading to immediate need to identify alternative sources of supply. Now, this is also very much driving the prices of commodities, energy global wide as well. There are omni-channel requirements with focus on agile networks to minimize disruption and to ensure consistency of supply chain, maintaining stocks at multiple locations. So some are bringing back to onshore, some are offshoring, but we are seeing more onshoring on some of the supply chain management. On tax or cross-border trade complexities, the discussions on, for example, taxes like the EU Carbon Border Adjustments Mechanism, CBAM, are going to be an anticipated cost increase and adding on complexities when it comes to emissions and taxonomies that will be implemented for trading into the EU. So there are also other areas like legacy on-premise IT support expiring, which leads to potential data security risks, data breaches, and also how these are going to affect the intellectual property of companies and customers. As well as when it comes to the ESG agenda, there is a clear push to decarbonize end-to-end value chain, Scope 1, Scope 2, and Scope 3, covering supply chain, to understand what are the transformation that is required, such as renewables, fleet decarbonization, EVs, so on and so forth. So legislation are being reviewed and revised for critical industry reshoring. So we are seeing supply chains moving closer to manufacturing has led to additional costs due to differences in cost onshore and offshore suppliers. So all these are just setting the scenes. But when we look at how companies are facing the challenges to meet their goals and mitigate sustainability risks across supply chain, these are some of the context of drivers where one of the key value proposition, it does increase growth if done well, and there are competitive advantage such as brand differentiation, customer loyalty, emerging markets, capturing the emerging markets in the supply chain. It is also to meet the stakeholders' expectations, as I mentioned earlier, and in terms of the controlling of the cost, there are less volatility when it comes to having the processes and strategy in place, as well as clear risk mitigations and business resilience. So if we look at from this slide, the key focus is also to mitigate the efforts when it comes to in a value chain that is very fragmented, which is what we see. there will be a need to look at not just the operational focus areas where the sustainability matrix are focused, it's also looking into the upstream and downstream. So different companies have started to strategize a more holistic value chain, looking at materials, assembly, distribution, customer experience, and disposal, and starting to relook at their business model when it comes to their supply chain strategy and management. If you see under the upstream operations and downstream, every part of the supply chain has the focus areas that it actually needs to be managed. So it may not be seamless when it comes to end of each segment of the value chain. But what's important is to ensure there's a process put in place handling the upstream operations and the downstream. So if we go on to the next slide, in terms of the pressure to achieve sustainable development goals is to also ensure that there is a sustainable supply chain finance market growth being pushed in the agenda exponentially. So these are the 4 key things that we've seen statistically. The first is when it comes to the global sustainability supply chain finance market is expected to reach US $2.9 trillion. When it comes to the growth, the importance is by firms adopting the sustainable supply chain management. And when it comes to the financial institution, it is also looking at witnessing a considerable growth that ties with the small, medium, and enterprises in developing countries. So it has been the focus for Malaysia in the past 12 months, and moving forward the next 1 to 2 years is also going to look at the SMEs focus market, as well as the third is by organization size, the SMEs are expected to witness a considerable growth over the next 8 years due to the focus to maintain optimal working capital. And on the fourth part is when we look at what the global market is on North America, the sustainable supply chain finance market is projected to witness a CAGR of 19.14% over the forecast period. Now, this is mainly due to more stringent regulations related to sustainable environmental practices. So when it comes to the opportunity for banks in ASEAN, this is the projected demand for additional ASEAN green investment from now to 2030. There is a very huge $3 trillion estimated total size of ASEAN green investment opportunities from 2016 to 2030. The optimum strategy financing is to actually drive finance green investments as early as possible, from where we see the key projects are in renewables, food and agriculture and land use, energy, and infrastructure as 4 key areas that will drive most significant projects. And to also take into advantage the investment opportunity on hand, driving competitive returns for investors. And what we're seeing is ASEAN issuers have also starting to secure more than 11% of global sustainable debt market valued at 76.5 billion in 2021. So what are the key insights that we've seen from some of the global banks is they have started to capture ESG opportunities through the offerings of innovative sustainable finance products to meet the demand. So StanChart have started to provide services for clients who are less than 5% dependent on revenue from thermal coal by 2030. They've also mobilized $300 billion in green and transition finance. HSBC is looking to prioritize financing and investment, those customers transitioning to lower carbon emissions. And the ambition is at $750 billion and $1 trillion of financing and investments by 2030. So UOB is building up their sustainable finance portfolio, $15 billion by 2023 next year, and double their combined portfolio for renewable energy, energy efficiency, green transport infrastructure, water and wastewater management in 2020. So DBS, under the DBS Green Bond Framework, they issued 500 million green bonds in 2017, and they've raised over Sing dollar 1.6 billion with Barbelli Income Fund and Sustainable Investment Products. So we are seeing quite a number of ramp up when it comes to the strategy. And when it comes to the role of capital markets, why this is important to accelerate is two key focus. One is rewarding green business through lower cost of capital. And this is important to ensure that the buying of stock and the lower cost of capital will raise the market value and encourages firms to self-regulate. And green business may also have lower risk of liability penalties, compliance costs in the future, and less likely to receive negative publicity or controversies. So investors that value environmental performance and adjust their cost of capital to account for underpriced environmental risks favor the greening of business. And we are seeing they're also reacting to information about environmental performance of firms that can impact the stock market returns. So on the right-hand side, we see that in terms of developing new green financial instruments, of course, there are a few key challenges and steps to be taken. There is a need to have green finance mechanisms to allow for how organizations and financial institutions will internalize their environmental externalities and adjusting their risk perception. So the discussion between financial institutions and the corporates needs to be fairly aligned. We are also seeing green investment by financial institutions, excluding Japan, has been growing steadily in the past years, while Japan has increased dramatically. So stock exchanges across Asia have started to launch ESG indices, including Bursa, who have launched 2 new indices on lower emission and Sharia low carbon indices, and also requiring further ESG disclosures as how Bursa have launched over the past 3 days. So certain types of green bond markets, especially bond investment in low carbon and climate resilient infrastructure, are growing rapidly in Asia. And we are seeing a rapidly growing product called catastrophe bond that pays out in the event of natural disaster. Singapore had entered the cat bond market for insurance-linked securities back in 2018. The stock exchanges have also started issuing guidelines for green bonds to open up bond markets to institutional investors such as pension funds and insurance companies, which have their own benchmark for green investing. So if we look at the next part is in meeting the demand for sustainable supply chain financing, as with ordinary supply chain financing, the funds from this financing would be secured by the receivables and used to bridge the payment gaps in open account trades. Now, the key difference is that discounted financing and thus the behavioral change incentive will be provided only where the buyer and or the supplier comply with the certain sustainability standards that represents this sustainable behavioral change. So the first part is when we look at the sustainable trade loans, it is loans that are provided to supplier for the sourcing or manufacturing of sustainable goods, services, or activities. Now, the lender will specify what type of goods, services, projects will qualify to have the attributes and provide the preferential rates to sustainable borrowers. Whereas the sustainable trade loans also fall into the broader category of sustainability-linked loans, which is very much common in the local scene now, aim to facilitate sustainable economic activity by incentivizing the borrowers to achieve prescribed sustainability performance objectives. So it could be reduction of energy intensity, it could be reduction of emissions intensity. Those are the key metrics that will actually support some of this sustainable trade loans build up. So the second part is when it comes to the payable finance program, the ESG factors can be integrated into the SCF through buyer-led payable finance programs. So under a sustainable program, supplier can sell or would sell their receivables at a discount to finance provider and receive preferential terms such as favorable lending rates or fast-track invoice processing for if they are able to demonstrate strong sustainability performance. These programs will also allow buyers to integrate their ESG considerations into their supply chain and achieve their own sustainability targets. When it comes to repackaging, the sustainable SCF and sustainable trade loans can be further repackaged into sustainable assets-backed securities for investors in the capital markets seeking to invest in ESG-related assets. Now, although still at infancy stage, there is a growing market for green collateral securitization, whereby securitization on securitized assets are labeled as green. So as this market develop, demand for sustainable securitization is also likely to develop, for securitization notes backed by sustainable supply chain receivables. So the OECD estimate that asset-backed securities issuance could be $380 billion per year in 2031 and up to 2035 period. So what are the key barriers now that we've seen that the landscape and trend, but what are the key barriers to actually drive sustainable supply chain financing? Now, we have seen skeptical impact of implementation as one of the critical factors. It's important to ensure that there are companies are able to provide credible self-reported environmental information which requires processes infrastructure for data gathering, monitoring and verification, inspection and penalties for non-reporting or falsification of data. So the regulatory infrastructure is often missing in developing countries, or it's being done manually or on an ad hoc basis. So we are also seeing insufficient data disclosures, requirements to address environmental or long-term systemic risk factors. So despite a strong business rationale for improved ESG performance, firms usually provide insufficient disclosures for investors to adequately assess their management of ESG issues. Now, with the Bursa and some of the regulatory push, this will take away some of the challenges because there is a certain level of streamlining on where the focus ESG are by sectors. So many SMEs, the third one is many SMEs predominantly contribute to economic activity in Asia, and they have shown limited response to green supply chain pressures, and they are lacking resources and capacity to also see immediate benefits to put in place some of the processes in relation to sustainable supply chain. So they are, in that sense, requiring funding, coordinated capability building, as well as framework and matrix development when it comes to supply chain management. So one of the barriers to scale is the lack of buyer awareness of the existence of such solutions, and the fact that buyer engagement requires cooperation between the various stakeholders. As you can see, there is a need to address what are the critical metrics and how to actually connect this to the sustainable finance product innovation. So this is also that in driving this solution, there's also a need to build sufficient economic incentives, such as preferential rate to encourage market uptake. So we do see it is quite a timely position when it comes to encouraging the market uptake, and this will be the window to actually drive and further scale. When it comes to the third part of barrier is measuring the impact. So of course, there are lack of standardized definition of sustainability, which means that it's going to be fairly judgmental when it comes to which metrics to be obtained or at least decided when comparing sustainability performance. There is a methodology or at least option to actually look at what are the available, consistent, comparable supplier sustainability data, which is key. And the market then now needs to develop a definition to ensure the reliability and transparency of data is also improved. So in terms of improving supply chain credentials, it is really looking to link ESG performance and the trade finance together. When setting up the sustainable supply chain finance programs, the first step is really to embed the sustainability matrix, linking the sustainability linked KPIs of the procurement department and rate, focusing on to rate the suppliers from an ESG standpoint. Now, the ratings would ideally take into account all the ESG dimensions in each of the subcategory and have a total weighted average rating. Second is really to set up the pricing model. So the SCF will provide, the SCF is tasked to set up the pricing model that will lead to the sustainability KPI set by corporate procurement department. And the program would then provide a preferential pricing to suppliers with a better ESG rating, hence in order to incentivize suppliers to strive to improve their rating. The rating would be renewed at fixed interval, but pricing is reviewed accordingly. The subcategory ratings are relevant as they provide transparency. So corporates and banks have no tolerance policy towards, for example, human rights, child labor violation, and will immediately take remedial steps in case a supplier receives a subpar rating on these aspects. So banks are exploring new ways to adapt existing SCF programs to incorporate sustainability-linked goals. Now, this solution would be more bespoke to create process to blend the functioning of the existing SCF program. Now, if done well, the SSCF program will have the added benefit of not requiring renewed buy-in from the long tail of suppliers. They will initially be offered the standard discount, and depending on their ability to meet the sustainability-linked KPIs, the discount could increase or decrease. So it's a performance-based program. Now, when it comes to case study, what we've seen, Deutsche Bank links Henkel supply chain financing to ESG ratings. And we have seen that there is the first ever conversion of an existing supply chain finance program in Europe to a sustainability linked program. It creates an incentive for suppliers to be more sustainable, and Henkel suppliers in Europe, which already participate in supply chain financing with Deutsche Bank, can benefit immediately. So what we're seeing the benefits to supplier is Henkel supplier can receive payment immediately after an invoice has been approved. Second is the suppliers can lower their typical financing costs based on Henkel's creditworthiness. And the third is they can further reduce financing costs if they improve their ESG rating. So what are the impacts to Deutsche Bank is they reduce the company's major impact on carbon footprint in the supply chain, and it considers the social aspects of good governance, and it increases the goal to the total value, to the volume of sustainable supply chain financing to 1 billion euros by end of this year. So it's really about partnership. And when we look at what are the sustainable supply chain green goals for payables, in the program, in terms of driving sustainable through payment terms, in a payables program, the buyer will then give its suppliers the option to sell receivables that are due from the buyer to the bank at a competitive rate based on the buyer's credit rating, which is typically better than of its supplier. So this will provide supplier the option to receive payment sooner than the original maturity date, and it also allows buyer to hold on to their working capital longer. So BNP Paribas recently structured a sustainability-linked payables program for a corporate client focused on KPIs for reducing CO2 carbon emission. And we see that this particular initiative was designed to incentivize the buyer with longer payment terms, and if they consistently meet their own defined emissions KPIs, and if the next at the next evaluation the buyer does not meet KPI, payment terms will be reduced, impacting the buyer's liquidity or working capital. So when it comes to the sustainable finance, they are trying to reconcile clients' economic performance with positive and social and environmental impact. By engaging in these programs, they can then serve as a catalyst for client sustainability transformation. So with that, what I will do is I will pause here for the sharing session, and I'll pass back to Navina.
Thank you very much for that, Arina. I don't see that there are any questions in the Q&A box, so I guess we'll move on for now. And then if you have any questions for Arina or any of the speakers, please do drop them in the box. So the next part of our session is we've invited HSBC Amanah, Citi Malaysia, and EcoVadis Spain to speak a little bit about what they've been doing in the area of supply chain financing. And to moderate the speakers, I'd like to welcome Ishita Damani, who is partner for business consulting, supply chain and operations for EY Singapore, to lead the session. So Ishita, over to you.
Thank you, Navina. Welcome once again, everybody. It's great to be here, utilizing our Friday afternoon to actually focus on our topic, which is here and now, the most important. I am delighted to have three fantastic speakers here with me who are going to share a bit of their viewpoint on sustainable supply chain financing solutions, and then we would have an opportunity to have an open discussion with them. So without further ado, I'll request our first speaker, Dafina, Defina is the Director and Head of Commercial Banking at HSBC Malaysia. She has over 22 years of experience as a banker and has been with HSBC for last 17 years, covering various roles in global banking and markets, global trade, receivable finance, Sharia compliant commercial banking products and solutions. And obviously she is now focusing on sustainability. It's fantastic to have leaders like Defina spend their energy and time on this topic. She graduated from University of Essex and has an MBA from Alliance Manchester Business School. So welcome, Defina. We are excited to hear your views on the topic.
Thank you, Ishita. Good afternoon, everyone on the call, and also to my fellow panelists. So I firstly would like to thank EY for inviting me to this MSFI workshop. And I'm really excited to be sharing what HSBC has done in the space of sustainable supply chain financing and how we can enable, customers' sustainable trade and supply chain. I would first like to start by defining what is sustainability, just taking a step back, because in our discussions with clients, we often find that sustainability has different meanings to different people and businesses. And we like to think of sustainability as a long-term strategy to supporting our customers and safeguarding the world we live in for future generations. Now we look at sustainability from three lenses of environmental, social, and governance. And of course, these are set of standards focusing on the three central pillars to measure the sustainability of investments. It is important to distinguish climate from the environment. Climate is one part of the environment, which most of us in the audience are very familiar with, but there are other factors like the usage of raw materials and water influences, the E criteria as well. So I think just to add to what Arina mentioned earlier in terms of the evolving regulations, legislation, market forces that has prompted a change in how the supply chain should be looked into. This is a very key point because based on market research, we have seen that up to 80% of the carbon emissions amongst environmental and social impacts are actually derived from the supply chain. So it is always the focus of the customer to ensure how do we minimize carbon footprint and ESG impacts from the supply chain, whether it's the customers, suppliers, their sub-tier suppliers, how raw material is being procured and sourced. Okay, so we actually ran a survey under HSBC Navigator to understand what businesses globally feel or think about the business environment that they are managing or operating in today. So what we found from the survey that was being done is that at least 96% of businesses globally feel the pressure to becoming more sustainable. And 23% of businesses see sustainable as a competitive advantage. Now, this survey was done across the globe, Malaysia included as well. But the theme and the feedback is quite consistent. And noting that there is an importance to focus on sustainability, we just want to emphasize that doing good is good for the customer's business. There's increasing push from companies to adopt as what was mentioned by Arina earlier, whether it's stakeholder pressures, government, green regulation, and so forth. And why is it good? Clearly, there are consumers that demand products that are aligned to being sustainable. There will be a brand standout for customers who actually do embark on the ESG journey. Reduce costs, definitely. And of course, it will drive product innovation. So we do see feedback from the customers that we speak to that it is more expensive for them if they wanted to look into transitioning towards ESG. So the cost factor is one of the feedback shared. And that's why programs like the Sustainable Supply Chain that provides a financial incentive would actually benefit some of these larger buyers and how they can push that across their supply chain. So where can financing help on this journey? Now, as a financial intermediary, how can we help the customer? So this is actually a roadmap for the customer to develop a sustainable supply chain. I think it first begins with the customer having the awareness and the ambition. This is very important because having a commitment and objective on sustainability, how that applies to the customer's business model would be very key. And next, of course, is looking at how the operational objectives are being set, how sustainability is being embedded into the corporate principles, such as sustainable procurement, or how the company invests in renewable energies, R&D technologies, and efficiency improvement. The next part is, of course, on the collaboration and enablement, and this really touches on the supply chain. So it's really about the customer encouraging the supply chain to ensure that they are taking the first steps to a more sustainable business model. And of course, what that means is being able to look at programs to providing the financing for the suppliers to embark on that journey. And finally, on business growth is really about unlocking business potential and driving business growth. So by enhancing supplier collaboration with clear incentives, reward suppliers, this will of course lead to potential growth through investment. Now, in terms of the host of solutions, sustainable solutions that HSBC and HSBC Aman does provide, it cuts across the spectrum, whether it's a sustainability link facility or loan, green bond, green sukuk, green loan, green financing, sustainable supply chain finance, supplier term financing, and of course, green trade loan or green trade financing. We do have end-to-end solutions to support the customer's financing requirements. I will just briefly touch about HSBC's sustainable supply chain financing program, and really how we can look to supporting customers to seize the opportunity. So really, sustainable supply chain financing is a proposition where HSBC can make early payments to the customer suppliers on terms that take into account the supplier's sustainability performance. And I think many large buyers today are setting publicly disclosed sustainable targets for their supply chain. And by working with these buyers, HSBC can look to provide financing for these suppliers who need to invest in environmental improvements that the buyers have set. And of course, it aims to support the supplies in terms of sustainable sourcing, reducing the carbon footprint within the supply chain. And this is really much relevant to looking at Scope 3 finance emissions. So what is the value proposition here? It's really about understanding clients who has a strong commitment in terms of their supply chain sustainability. And of course, it mobilizes and motivates suppliers to improve on meeting that objective. And of course, what is key to highlight here is that there would be benefits in terms of the rates are more attractive to the supplier because it leverages on the buyer's credit position. And if the KPIs are met, then the rates would be better. So it is in a way, there is a financial incentive. It is a benefit for both the buyer and the supplier to look into the sustainable supply chain program. Now, in terms of the advantages of a sustainable supply chain financing program, I just wanted to highlight 2 key points here. So of course, the first being is to really support suppliers' sustainable CapEx investment, whether they're through lending or financing solutions with preferential terms. And this is where the supply would have a lack of access to financing. Now, for suppliers seeking a financial incentive, this is where we can look to optimizing the working capital, encouraging the suppliers by setting targets set by the buyer on a supplier sustainability score or certification. And this will, of course, be a win-win for both the buyer and the supplier. Okay, I would like to highlight this case study for Walmart. So this is a case study done by HSBC for an international retailer. HSBC provided a sustainable supply chain finance program to support Walmart's sustainability initiatives. So what Walmart wanted, they wanted a bank that can provide tiered pricing to their suppliers to drive certain sustainability goals, which is part of Walmart's Project Gigaton and Sustainability Index program. So just to share briefly, Project Gigaton is Walmart's initiative to remove 1 billion metric tons of greenhouse gases, hence Gigaton, from the global supply chain by 2030. So that was a target set by Walmart. Second thing is Walmart wanted to have a sustainability index scorecard to help their suppliers and to encourage continuous improvement in meeting Walmart sustainability objectives. So these targets or KPIs were actually provided by the Sustainability Consortium, TSC. So how HSBC came in, we were able to support this program. It was hubbed out of Hong Kong, and we were able to offer better trade financing terms to Walmart suppliers who demonstrated an improvement in the sustainability targets. So I just wanted to share briefly about HSBC's ambition to building a net zero economy. I think in the earlier presentation, Arina did mention HSBC does have a very strong commitment in terms of our ambition to net zero. We have declared being net zero bank by 2050. And for HSBC Amanah, we are one of the members of BNM's value-based intermediation community of practitioners. And we have just recently launched our triple bottom line framework, which looks at the planet, people, and prosperity, which is in line with VBI guidance issued by BNM. In our journey towards sustainability, we have done several key mark transactions across the spectrum, established the TBL framework, providing disclosures such as the TCFD, ensuring close engagement with our stakeholders, enabling talent and capacity building. And of course, all this is aligned with Malaysia being an international Islamic finance hub. So this is actually my last slide, just to share some of the achievements that we have done in terms of sustainable financing, which includes a sustainability linked financing done for Yinson. We have done some green trade financing for a cocoa manufacturer. Now it's really about sourcing from sustainable sources. I mean, we spoke earlier about making sure the entire supply chain does have a plan on how they intend to meet that. And of course, we have won several awards in terms of the deals that we have done. This ends my presentation. I'm sorry, Ishita, if I've overrun, but happy to take any questions now or later after the discussion.
Thanks, Safina. I think congratulations on the incredible stuff that you're doing at HSBC. Fantastic. If you don't mind, we'll keep the questions for the panel session, and I'll take this opportunity to invite Jalil. So Abdul Jalil is currently the country head for Citi's Treasury and Trade Solutions in Malaysia. He has been with Citi for 17 years, worked in different areas of treasury and trade across Malaysia and Hong Kong. In fact, he started his career as a management associate, worked across key payment receivables infrastructure, launched various first foreign bank initiatives, and now he's obviously spending some energy and focus on sustainability. Fantastic to see that, Jalil. And I'd love to invite you to give us a perspective on Citi's sustainable finance initiatives.
Thanks, Ishita. So good afternoon to everyone. And it seems to be a rainy afternoon here in KL, but we'll try and get some of these materials across to the group here. So just to start off a bit in terms of some of the ESG and rising up in the treasury agenda, we know the last 2 years has been somewhat a very disruptive, right? But if you look at it from a sustainable on ESG financing perspective, the total sustainable market looking at 1.5 trillion in 2021 is looking at moving to a 2.5 trillion in 2022. And this includes of green financing, which includes green and sustainable linked bonds, and is forecasted to be raised in 2022, representing almost a 60% year-over-year growth. And as a result, what we do see is that ESG financing is becoming a key component to raise capital, right? 56% issuers up from 30% in 2022, and 64% of issuers will be expecting to actively seek ESG financing as well. And given that most of our clients and target clients are primarily from the treasury area, what we do see is that treasury is seeing an increasing role in enabling supply chain sustenance in Asia. Some of the key top trends in terms of impacting the treasury function, we looked at it in terms of new regulatory requirements, 24%, supply chain disruptions, 28%, and growing ESG requirements is a whopping 30% as well. As a result of these top trends, the top treasury priorities include, one, accelerating digitization, which we have seen pretty much in the last 2 to 3 years as a result of the pandemic, optimizing payment methods, which is looking at 22%. And what we do see our treasury clients, etc., is improving supply chain financing program, which is 30% of the participants looking at that. And in terms of Citi, what we do look at it from a Citi Sustainable Supply Chain Finance is we look at it from a perspective of a certification from an independent third-party verifier. And every attempt is made to offer sustainable suppliers the opportunity to boost liquidity and accelerate cash flow through discounting of approved receivables at preferred rates. And I was just looking at the Q&A before speaking. There was a question regarding in terms of in the sustainability space, how do business or banks, whether the supply chain meets certain KPI or whether it's KPI reducing CO2, having a part of the third-party verifier as part of the ecosystem helps that. And I know my partner Alex would cover that in more depth. But let me talk a bit about what's our Citi Sustainable Supply Chain Finance. One is really sustainable goals. Citi partners with our clients and sustainable rating partners to provide a sustainable supply chain finance program in line with our clients' ESG objectives. We also look at from a sustainable targets as well. Our clients are working with third-party verifiers to independent audit to verify and track suppliers against predefined sustainability targets as well. And as part of a supply chain finance, we also look at the financial incentives, how Citi can help reward qualifying suppliers to meet the sustainability targets with preferential discount rates. And that incentive rates helps them in terms of meeting their sustainable targets. Arina talked about some of the escalating costs, etc. as part of being sustainable. This what helps the suppliers meet those targets and goals as well. And also talk about inclusion, where ESG initiatives may avail at a lower cost of financing to smaller suppliers that will otherwise be left out of a traditional supply chain program, right? And just to look, for example, at Citi, 47 of our suppliers in Citi supply chain program have an annual throughput of less than 1 million, giving you the sense of that inclusion that we put as part and parcel of a supply chain finance program. Now, when we look at a supply chain finance program, how does it really work? Right? How does it work with a certification from an independent third-party verifier? Right? And how does it help the suppliers to the opportunity to boost liquidity and accelerating their cash flow? In a normal commercial contract, the buyer and suppliers generally enters into a commercial contract, and in the sustainable supply chain, the buyer will then notify the third-party verifier of which are the suppliers who will be eligible for the program. The third-party agency will then certify the supplier's compliance against a set of sustainability criteria. And once this is done, the agency then confirms the list of suppliers over to Citi, which will then use as an input in terms of onboarding these suppliers into the program in order to create that sustainable supply chain finance. And I wanted to end, in terms of, after talking about how it works, to really talk about a case study where we have a sustainable supply chain finance. This is a case example that, of course, certainly won some of our Adam Smith Award back in 2021 as one of the best supply chain finance solution. And the client is really a chemical and consumer goods company in Europe. And the client's sustainable strategy includes 3 main goals. One is to become climate positive, fostering a very circular economy, and third, to enhance a positive impact to their communities. And the client need here is that as part of a client's responsible sourcing process, the emphasis was really on improving sustainable sourcing in the lines of environmental, labor, and human rights improvement. And the client needed to expand the assessment process to a wider suppliers and to reward those in terms of meeting their ESG targets. The solution here that we have done for this client here is to put up a sustainable supply chain finance in Asia Pacific, And it was a first client and its first launch in Australia, which will also be expanded to additional markets here in Asia Pacific. It is targeted at existing or even new suppliers who demonstrate strong and improving sustainability performance as well. And those qualified suppliers can access our Citi supply chain financing platform at a preferential rate on a tiered basis, with rates improving as the supplier's sustainability scores improve. And that's where part and parcel of that overall circular process of being certified, showing progress, and enjoying that particular benefit in terms of that whole sustainable chain. The outcome is that the qualifying suppliers benefited from cash flow acceleration, quicker payment, and improved financing costs. Right? And this sustainability also cuts across our Citi large supplier ecosystem so that they can also benefit as part of that program. Okay. So that covers my part. Ishita, back to you.
Thank you, Jalil. That was fantastic. Appreciate your sharing. And now, finally, switching gears a little bit, we're going to invite Alex from EcoVadis to talk a little bit about the sustainable supply chain financing solutions for banks, fund managers, and financial institutions. So Alex is leading EcoVadis's development and deployment of these solutions. These include ESG risk management solutions for investment managers, as well as ESG-linked lending and sustainability-linked financing solutions for banks and other lenders. He's joining us from Europe. So thank you, Alex, for waking up this early and making time on a Friday morning for us.
Hi, no problem. And it's thankfully not too early here in Europe. It's a relatively normal time, but very happy to be here. Thank you all. So I'm going to focus on today's call on the topic that we're all discussing, which is EcoVadis' sustainable supply chain finance solution. Obviously, as you mentioned, we have many other solutions in the sustainable finance arena or area, but I'm going to be talking here today about how we apply our methodology specifically to trade finance or supply chain finance. So first, just to talk a little bit about our EcoVadis methodology. We have our own proprietary ESG rating methodology that we use to rate kind of any business globally. This methodology, while it's our own methodology that we've built, is very much aligned to international standards as well as local or international standards, such as in the EU, as well as kind of local national regulations that have been put into place by governments. We have 2 independent boards that oversee our methodology and advise changes on a yearly basis. One of these boards is focused on regulatory changes, as I just mentioned, and the other board is focused on scientific changes that are published. We want to make sure that our methodology is updated so it remains current and is applicable to the companies that we're rating. The EcoVadis model started as a business. So we started as a business over 15 years ago, providing services to large corporate buyers around the world, rating their suppliers to help them manage ESG risk within their supply chain. And they typically do this within 2 different strategies. One is so that they can make procurement decisions around which suppliers they use and how much business they transact with those suppliers. And the other is to help suppliers improve their ESG scores. And that's using our platform, using our program to do that, because a big part of the EcoVadis rating system is to provide real, usable, tangible results to each company that we rate, each supplier, so that they can make changes year on year and track those changes through a yearly assessment process with EcoVadis. And that's really key to assisting the corporate buyer in their procurement sustainability strategy and to reduce ESG risk within the supply chain, but also lends itself very well to the usage of these scores in a supply chain finance program, because it means supplier scores, supplier ratings can be linked through some sort of financing mechanism and reward suppliers for good performance or a good increase in their ESG performance over time. So I'm just going to talk a little bit about, sorry, I'm just going to go back one slide and say one more word here about our methodology as I explain kind of the EcoVadis model for assessment, because we're relatively unique in the ESG rating space because of our history in supply chains, as well as the global nature of global supply chains. And the various diverse different types of suppliers that you will find within those supply chains. So it's very important for us at EcoVadis that we're able to rate companies all across the world in all different jurisdictions and companies of all different sizes, from a few employees to thousands of employees, and importantly, of suppliers in any different, many different industries. Spanning the entirety of all kind of existing industries, more or less. But to be able to produce a comparable ESG score for that diverse set of companies, and indeed companies that are privately held or SMEs in many cases, we use a relatively customized approach to assess them while still being able to produce a score that is comparable across industries and across different company sizes. And we do this in a couple of different ways. To address the issue with availability of data, when you're talking about SME-sized companies and privately held companies, we work off of a direct engagement model and a program model. This means that when we approach a supplier to rate them, we always need to be engaged directly with that supplier, and that supplier needs to be a part of the EcoVadis network. In order for us to accurately rate that supplier, we actually need to gain some information and documents and evidence directly from the supplier themselves about their internal operations. And I'll explain in a second kind of our model to do that, but it's important to note that that's the way in which we are accurately able to rate suppliers on their real ESG performance and improvement, as opposed to many other ESG rating providers which focus on companies' information that they have already published, information that is already out there, and or proxy data. So coming back to how we're able to accurately rate a diverse set of suppliers and companies across the world in various different industries, we do take a relatively customized approach. So these 21 sustainability criteria that you see here that form part of our methodology are not always activated for every assessment that we do. As you can imagine, a company that's a legal firm based in Japan with 50 employees is going to have very different sustainability considerations as compared to, for example, a manufacturing plant based in Vietnam or a mining company in Australia. So we take a materiality approach when we look to rate a company, and we have three categories which we look at. That's the industry sector or activities that the company is engaged in, where the company is operating, their location, their jurisdiction, as well as their size. And we look at size in terms of number of employees. And so between those three different categories, we have over 1,500 different questionnaires that are standard questionnaires, but there's 1,500 of them. And so we have a big range of different options to choose from to make sure that when the questionnaire is sent to that specific supplier or company to fill out and to answer, it's only going to be asking relevant questions for them. Because what we don't want to do is have a one-size-fits-all policy where we send the same questionnaire with the same questions, no matter the company size, no matter their location, and no matter what industry they're in. It's important that we're asking questions that are relevant for the company, questions that they should be able to answer or have some sort of documentation or response to, and can provide us valuable insights into their internal management processes. So when we look at a company through this questionnaire process, it's very important to note that we're not allowing any kind of self-assessment through that questionnaire process. The questionnaire is less of a questionnaire, let's say, and more of a request for documents and information around those documents and evidence. We have a kind of three-pronged approach in that questionnaire process, and that's to look at policies, actions, and results. policies being the company's policies that they have in place around all different areas related to ESG issues, let's say labor, human rights, environmental or pollution issues, etc. We also ask for examples of actions that the company has taken based off of those policies, including things such as licenses or certifications that they may have obtained. And we also look at results, so that being KPIs or data that has been collected that they share with us so that we can, further back up the fact that these policies are in place and that they are following them. And these are the kind of KPIs, data and results to prove it. So that's kind of a very important part of our assessment process, is this questionnaire that is sent to the company and the documents and evidence provided directly to us by the supplier in question. We don't we don't only look at what the company is giving to us. However, we also look at third-party inputs where possible, and we have a tool called 360 Watch, which is scanning and collecting publicly available information on that company that does exist, and all of that will go into our assessment as well. Just had a note here that we have about 5 minutes left, so I'm going to go a little bit quicker through the rest of my slides here. But once we have that information from the company, once we've collected the publicly available data and information from third parties, we would then publish that scorecard on the EcoVadis network. The only important thing to note here on top is that because of the confidential nature of the information that is going into our scorecards, it's important to note that the company for whom the scorecard is published retains legal right over who has access to that scorecard within the EcoVadis network. So a company or a supplier always has the opportunity to disallow sharing of their scorecard with another party if they so choose, although it's not something that we see as a major issue in most of the programs that we run for corporate buyers or indeed for banks, accessing supplier scores to be able to provide supply chain financing linked to our ESG ratings. So just to give you a short view here of the EcoVadis scoring scale, like I said, we do that customization in terms of industry, in terms of company size, and in terms of location on the way into the assessment. And we also then weigh our different themes, which you saw on our methodology page, the typical E, S, and G plus sustainable procurement themes that form part of our methodology. Those categories are also weighted depending on the company's activities. And the idea is that when a company has a 65 or a 45 on the EcoVadis scoring scale, that is comparable no matter if the supplier is a small supplier, based in India that works in a legal firm or a consultancy service, versus a very different type of company in another location, such as a manufacturer of chemical products in Malaysia, for example. So if they both have a 65, it's going to mean roughly the same thing in terms of their maturity in ESG management and ESG risk. So coming to more directly to the topic of supply chain finance and how EcoVadis scores can be used, we really piggyback off of our strong space in the procurement sustainability service that we have for many buyers around the world already, and indeed can be very useful for making procurement decisions and reducing ESG risk in procurement. And really what we do is we share the score information for this subset of suppliers who may be participating in a supply chain finance program with the bank or with the funder, so that they can align terms or financing terms in some way to what the to meet the needs of what the buyer is looking to do in terms of sustainability on a broader level. Kind of coming to the point that my colleague at Citi made here today, which is we're always working for the buyer to help them in their overall ESG related goals, and we see aligning procurement and treasury as a real way to help do that through this kind of sustainability linked supply chain finance program. And it will also, of course, support suppliers both through their ESG journey, as we should be doing or would be doing already, individually one-to-one with that supplier, but also rewarding them financially via the bank's program. So really providing a two-pronged approach to help suppliers improve their ESG, which is also, of course, fulfilling the targets, the requirements, the goals that the buyer may have in terms of sustainability, and of course, helping the bank to deploy their capital more responsibly and to target ESG improvements among their customer base of both buyers and suppliers. So just a kind of schematic view here of how it works. And just to say as well, it's not always the case that we need to have the corporate buyers procurement sustainability program launched first. You know, we've seen all different ways in which we've launched these programs with our partner banks to date, including Citi, which is on the call today. We can either convert an existing supply chain finance procurement sustainability program that we have with a corporate buyer if the bank also has an existing supply chain finance program. So we've done that quite a few times now with several banks and several buyers. We can also launch a brand new procurement sustainability program for the buyer at the same time that the bank is working with them to launch a supply chain finance program, and linking those two from the very start and in tandem. And we've also seen the reverse, where the bank is talking to clients and suggesting the idea of supply chain finance and potentially also linking those supplier scores to some sort of ESG metric. And through this kind of conversation opens up the idea that the buyer can also use EcoVadis scores to do that, but also then manage their procurement decisions and ESG risk within the procurement space and procurement team through those same ESG ratings. So an EcoVadis rating can be used for multiple purposes, and we don't charge additional fees, you know, if the supplier is using that score for multiple purposes, and same kind of point of view from the view of the corporate buyer. Just a note here, which I'll skip through. As I'm sure you all know, there's multiple ways in which banks or financial institutions can integrate ESG ratings, such as the EcoVadis rating, into their financial products and supply chain finance programs. We're not financial advisors at EcoVadis, so we're simply providing as much advice as possible around the ESG scoring that we do, anonymized data from our network, so that banks and financial institutions can work with buyers to create appropriate incentive levels for the suppliers in this type of program. And that, sorry, I missed a slide here, and just a view here of how that could look. You know, you'll have an EcoVadis score of X, a level X, and then a corresponding incentive, potentially a discount on the interest rate margin or something along those natures. You can also, we've also seen it work where payment terms are adjusted based on the EcoVadis score, and indeed eligibility to participate in a supply chain finance program dictated by an EcoVadis score level, or just the fact of as to whether a supplier has an EcoVadis score or not. Yeah, sorry to run over time there, but that brings us to the end of my presentation, and welcome any questions that you all have for me. Thank you.
Thank you, Alex. Thank you, Alex, Jalil, Navina. Fantastic presentations. I think setting a great stage for our panel discussion now. So, I mean, I work in supply chain, have been in this area for the last 17 years across the region, helping companies make their supply chain responsive, resilient, and sustainable, right? And one of the key challenges or focus areas for supply chain leaders has always been cost, right? Reducing cost. Now, in many cases these days, especially in the developing world, it does seem that to achieve that nirvana stage of a sustainable yet cost-efficient supply chain is a key challenge, right? How do you reduce the cost while still having a sustainable supply chain? So keen to get thoughts from all of you on how, you know, the financing solutions that you have actually enable supply chain leaders to reduce cost, manage their cost, while also building out a sustainable supply chain. Any of you, anybody who wants to start?
I think just here from the EcoVadis perspective, this is kind of why we have the rule, let's say, that we require the buyer to be understanding the value of what we can do for them in terms of rating suppliers on ESG within their procurement sustainability program with EcoVadis. And we really couple that procurement sustainability program, which has real value to the procurement team at a buyer, to the financing program that can be linked to those scores. And really the financing part we would call not an afterthought necessarily, but a bonus add-on feature that can be coupled to that procurement sustainability program. And in that way, because the ratings are being used for more than just one purpose, a buyer and suppliers can get real value out of the fees that we would charge them to produce those ratings.
Yeah.
Interesting. Fantastic. Thank you, Alex.
And Ishita, also from a cost perspective, right? I mean, there's some part in terms of direct costs to what Alex was mentioning, right, and the benefits that brings to that. But there's indirect benefits that comes that may not be able to measure, right? One is that the extended working capital, which comes back as a benefit in a different scale to both the buyer and the supplier as well.
Right, and I think that's a very interesting point, right? Because sometimes we don't think about it on a year-on-year P&L basis, but that benefit on a long-term basis does bring value back to the company.
Yeah, and assigning particularly how that affects the working capital chain is something that some treasurers and procurement should look at collectively as part of an overall ecosystem.
Okay, any sectors, right? Any target sectors or customer areas where you think some of these supply chain finance solutions that we've been talking about, right? Or capital the deployment solutions we talked about really have the highest impact from your experience? Maybe Dafina, do you want to start on that?
Sure, Ishita. So based on our discussions with our clients, what we see is corporates in industries with heavy supply chain impacts, such as those with heavy scope 3 indirect emissions from the supply chains, are likely to pursue supply chain sustainability. And sectors which we see may adopt SCF could be those in retail, consumer products, manufacturing, auto, electronics, telco, and pharma. But of course, a lot of these discussions are very much, we're engaging with the customers in terms of, for them to look into embarking on a sustainable supply chain program.
Yeah, I agree with Dafina. I think that where do we see applicability of the supply chain finance is primarily on the fast-moving consumer goods, consumer healthcare, where there is a working capital cycle, right, from both procurement until the whole obtaining the cash.
Understood. So, I mean, some great case studies were shared, and I mean, fantastic results, right? And Alex, you alluded to a little bit around the data side. So, I mean, just practically speaking, data remains a challenge when it talks about supply chain financing solutions. How do I tangibly prove that I am actually making an improvement to my scope 3 reductions, or, just making sort of paying fair wage, or any of the considerations within sustainable supply chains? How do you guys practically tackle that? And I would really appreciate if you could maybe pick on the exact data points you used in the case studies you presented. Maybe Jalal, do you want to start on this one?
Okay, so I was mentioning this in terms of the deck, right? The best one is to work with a third-party verifier. All right. At Citi, we work with EcoVadis as our verifier as well, working with our partners in terms of making sure that in terms of the data, in terms of they're making improvement to sustainable and to ESG principles, right? And based on that piece, we then use that in terms as part of our onboarding exercise into that whole supply chain program.
Yeah, and maybe just to add on there from the EcoVadis perspective, obviously we consider ourselves a third-party verifier when it comes to ESG data, and even within EcoVadis, we have very much Chinese walls separating the teams that do the actual analytical work to rate suppliers, to rate companies, from our frontline staff that deal with our customers and run the programs for customers like Citi, or indeed the buyers and suppliers that we work with directly. The way in which we run our program, kind of as I alluded to during my presentation, is very much on an evidence basis. So every point, every response, or every anything that a company or supplier is telling us through the assessment process has to be backed up by some form of evidence and verified by our team. Otherwise, it would not be included in the rating. So when it comes to looking at a company's policies and the way that they manage ESG risk themselves, we're digging into their own internal documents to look at how they are managing those processes, those issues, as well as collecting KPI and data points that are reported through our scorecard and reporting functionality. And then, of course, a really big part of what we do is providing those results to suppliers directly in terms of what we would call corrective action plan. So essentially a list of improvement points, things that the company can make changes to those processes to improve how they manage ESG, or maybe if there is a kind of missing documentation that kind of company normally should have, or policies in place that they don't have in place or don't have documented. And through our program, they can work to make those changes. We're not consultants, but we do provide quite a bit of detailed guidance that should be applicable for each company through that corrective action plan. And it's through that process that the suppliers can really take advantage of what information we're providing them to improve their score year on year, which should yield financial benefits if they're participating in a supply chain finance program that may be provided by Citi or any of our other banking partners.
Interesting. And, quite a broad range, extensive coverage of data points you had there, Alex, which is fairly impressive, right? Because one of the challenges with sustainability is that it's such a multi-pronged topic, especially the way it impacts supply chain, that you wonder where do you start and how do you collect the various data points. I was wondering if there are any more additions to this data comment.
Maybe go ahead.
No, I wanted to add on, to what Alex has mentioned, right? By having a third party verify, it also fulfills some of the independence that it's sense, and also to fulfill some of that governance piece. That how do you ensure that there is no biasness in terms of that verification process? I think that's an important point, which I think it's something that may not necessarily be well understood in terms of, oh, why do I need a verifier in this process?
Got it. So, Dafina,
sorry. Yep. Ishita, maybe I just want to add a bit on that. So, like for HSBC, when we look into the SSCF structures, so really it is the anchor buyer or the client that takes responsibility to rate their suppliers, right? So we do also look at how the buyers assess, the sustainability performance of their suppliers in line with the scorecard or the targets that they have. And of course, just to add to Alex and Jalil, of course, we work with the supplier rating providers. I think EcoVadis is also one of them. And like Walmart's case, they use TSC. So there are various third-party suppliers that we do work with, but I think ultimately we also see how the buyer, how they take the responsibility to ensure that how they rate their suppliers in the SSCF program.
Understood. I mean, I'm going to, at this point, encourage the audience, and we have almost 120 strong audience here, to ask more questions. We have 4 fantastic speakers here, so please do go ahead and ask questions. But in the meantime, as I wait for more questions to come through, I'll sort of take this data point a step further, because in my experience, this does remain a bit of a challenge, right? So any tips, ideas, recommendations you could give to suppliers, you could give to manufacturers, retailers, in terms of actually managing their data better so that it is easier for you to provide these supply chain financing solutions to them? What could be, other than engaging a third party to do this, what else could they do internally?
Maybe I'll kickstart that.
Please, Arena.
Yeah. I think what we're seeing in the market is really the value proposition of why we are going towards this is there is a clear disruption of business within the supply chain. From 2 angles. One is coming from a social license to operate. So you have to maintain your social license, otherwise you will start dropping down from the preferred supplier list. And we've seen that for the likes of, oil and gas majors like Petronas, unless and until you have very clear health and safety ISO guidelines and performance for environmental and health and safety, it's very hard for you to be within the supply chain of the likes of Petronas, oil and gas. Where else, if you are within the supplier to external exports, as what Davina has mentioned, if you're in the semiconductors business, these are very much normal in Malaysia to actually have some form of processes in place already. The only challenge is for those businesses that are operating locally and have not plugged into the international supply chain, but are aspiring to open up to global trade or plug into preferred supplier list. What the value would be is to get on and understand the value proposition so that they can tap on the sustainable supply chain financing in a strategic manner. So we are looking at awareness from the main buyer to inform the potential buyer. So this forum is very important. But that was only point number one, right? Social license or having license to operate within an end-to-end supply chain. The second part is going to come from a costing perspective, because if the focus is really to reduce emissions or energy efficiency, that by itself is cost saving if done properly and correctly. So regardless whether the business is going for such financing, for them to get on energy efficiency is a cost savings mechanism for themselves, a very direct understanding. The only thing is now there is a plus point, because if I were to not just cost save through energy efficiency, but I am plugging onto SSFC, sustainable finance, then I can have double value to get on that. But the key thing is they must access and have conversation such as this with the financiers as well as the main buyer. So there is an ecosystem that needs to facilitate this coordination.
Fantastic. Any other build-ups on this? Otherwise, I have some very interesting questions from the audience.
Yeah, I think one of the most common questions is that, of course, where do we start? I mean, from a supplier, where do I start? How do I initiate this conversation, right? And in the buyer organization, the most first pit stop, I would say, is to speak to the procurement. That's the key department, the key pit stop, really start talking about a supply chain conversation.
Wonderful, wonderful. So we have just a few minutes left, and I really do want to give some time to audience questions. So I'm going to sort of pick up some of the questions that have come through. So somebody's asked, given that SMEs are also part of the global supply chain, how should banks go about financing these customers if there was no due diligence performed on them yet?
So maybe I can start this one off and just answer and say, from the EcoVadis perspective, something that we're very good at is supplier engagement. So we have a whole team dedicated to this. And what we would do normally to launch a corporate buyer procurement program, and it would be much the same if the bank was also reaching out to suppliers to bring them on board, because we also see it's always dictated kind of by the buyer and by the bank who's going to do the outreach. EcoVadis is always the one leading the charge in terms of that outreach, but it's directed by, the bank and or the buyer and or jointly kind of by all parties involved. But really something that we're very focused on is that supplier engagement, because in order to accurately rate a supplier and to also assist the supplier through their ESG journey, we need to be engaged with them. We need to discuss with them. In the case of EcoVadis, they need to have an EcoVadis program of their own to have that scorecard published. Of course, there may be other providers out there, but in terms of from the EcoVadis perspective, we are very focused on bringing that supplier on board to our platform, and that whole process is involving accessing information from their internal systems to accurately rate what they're doing on ESG and to give them the results and tools that they need to make improvements over time, in conjunction with the buyer's procurement program as well as the bank's supply chain financing program. And through that kind of combined approach, we see very good results, not only in bringing suppliers on board, but also improving their ESG management overall.
And interesting. And if I may ask, typically, how long does it take you to do a first level assessment?
There's a kind of two answers to that question. So one is on the EcoVadis side, it takes 1 to 2 months normally, and that's kind of, we promise maximum 2 months for us to complete the assessment once we have the information provided. But when it comes to collecting that information, it's very much up to the supplier as to when and how they provide it. Obviously, we design our processes to be adapted to the size of the company, the location of the company, and we have support in multiple languages across the world, including local support through that assessment process. But on average, it takes about a month for a supplier of any size to complete that assessment with us. You know, in some extreme cases, it can be done within a week, and other extreme cases, it could take 6 months. But it's very much up to the suppliers to how quickly they provide that information to us. And then on our side, it takes a couple of months. So it is a relatively lengthy process when you compare what we do to maybe other ESG ratings providers. But in the context of what we're doing is actually really looking into SMEs, into privately held companies, and being able to produce that very accurate score on what they're actually doing. And through that process, it makes sense to do it in that way, because then in terms of financial rewards, you can be assured as a Citibank, as an HSBC, or as any bank, that the financial incentives you're providing to those suppliers are actually related to real impact and real performance at the supplier, as opposed to kind of a proxy rating of their peer group or that type of supplier, based on risk that may not directly relate to what that specific company is doing. So we see kind of our model of direct engagement as a real way to reward suppliers for their actual performance and to be able to accurately rate what they're doing in terms of improvements.
Thank you. Just there's a question that's been asked twice, and I think it's an extension to what you kind of answered, Alex, open to anybody, right? So ESG data remains a challenge. We talked about it. How do you know, how do the business or the banks know whether the stakeholders in the supply chain have met certain objectives? Example, reducing CO2, when this piece of data itself is challenging to measure or capture in the first place. So are there any brilliant ideas there?
I can take on the first, because emissions is a very evolving data measurement if you look at Scope 3. But Scope 1 and Scope 2 are fairly straightforward to be obtained. Your Scope 2 is your 12 months Tenaga bills, and your Scope 1 is really to get from the motor vehicles that you earn and the fossils that you burn. So in that sense, I would say Scope 1, Scope 2 are typically in the market easily obtained and can be verified fairly easily. Of course, if you enter into the Scope 3, it gets more challenging. But what we're seeing is to incentivize performance improvement where it matters the most. And for most of the supply chain management, it is in your Scope 2, your energy, your 12 months electricity bills, which as long as you pay a particular focus for operational efficiency in your Scope 2, typically you would be able to sort of draft that improvement and financing alongside Scope 2 as a start before you go on to Scope 3. So I would say that it depends on what's your business model, but from experience, typically it's definitely, if you say 12 months of electricity bills, is not something very difficult to be audited, checked, and to drive a performance matrix improvement around that 12 bills.
Thanks for that tip. And in the interest of time, there's just one question which I would really like to ask. It's a wonderful question that's come through from the audience. And it's a very broad question, right? So if I can just ask all of you to take a quick 30-second shot at it, please. What would be the next step to infuse sustainability in the existing supply chain financing solutions that are already out there? So what's next in this space from a financial organization perspective?
I'll take a first stab at that. In my experience, one is awareness of it. Two is that there are a lot of programs in the market as well. And I know financial institutions, and particularly if you look at it specific in Malaysia, the JC3 is also part of the agenda in terms of pushing more awareness. you can't get demand without awareness. And I think solving for that awareness piece in terms of forums such as these, and as well as talking to your financial providers or talking to the procurement, is that initial step in terms of getting that conversations. And as such, whether it's banks like Citi, HS, or any banks in the market, who has a sustainable supply chain finance program, is able to then have that conversation at the buyer to create a buyer program, is if there is enough sufficient demand on the supplier side.
Yeah, and I'll just echo to what Jalil mentioned. I think the awareness bit is very key. I have discussions with various clients within the commercial banking segment that we support, from SMEs to mid-market corporates to the larger corporates. And it's really about driving the awareness, whether they're the listed corporates that already have a sustainability commitment. It's really about, is it the right time? When should they actually transition? They may have very clear plans, but in terms of really embarking on a sustainable supply chain financing is something that needs further awareness. I mean, even without the sustainable bit, a supply chain financing program where early payment can be given to the suppliers who are the SMEs, that is something that we need to drive further. But of course, we look at a customer's profile in terms of sustainability, and they can be at various journey, in their sustainability plan, right? So it's really about understanding at which stage are they, how does it align to their business model? And of course, we can, as a financier, we can see how we can guide the customers in terms of guidance, whether it comes to financing, whether it comes to linking up them within the ecosystem. So earlier this year, just to share, we signed an MOU with Bursa Malaysia, is to support the PLCs who want to transition towards ESG. And some of these discussions did lead towards a sustainable supply chain financing program. So I think it boils down to awareness and making sure we don't leave the SMEs behind, because they are the largest contributor to the economy, and they're always at the last end, given that they're still struggling with making sure they can remain afloat in today's current operating environment. So sustainability can be last on their, on their plans, and programs such as SSCF is supposedly to help drive that with the suppliers to the larger buyers.
Thank you, Dafina. Any more closing thoughts, Alex, Arina?
Yeah,
Sure,
Alex, go first.
Okay, thanks. Just quickly from the EcoVadis side on the topic, we've seen a lot of interest and programs that have been driven originally by buyers, as well as programs that the banks have come to us with kind of to expand their product offering. So we see it from both sides. And focusing a little bit specifically on the APAC region, we have seen a lot of interest. Obviously, we have some live programs, one of which is with Citi, and we have a lot of interest from banks in the region wanting to offer this for specific customers, and also requests from buyer customers or buyer clients of ours that want to use their EcoVadis ratings in these types of programs. So we see it driven from our point of view, from buyers and from banks. I think a lot more buyers than banks are becoming aware of this concept and wanting to expand in this space. And from our side, we're not so focused on the suppliers in terms of them launching these types of programs, but obviously we have very good engagement from suppliers when they're offered the opportunity to join one of these programs, as we've done conversions in several different areas of the world with multiple different programs, converting an existing supply chain finance program to being sustainability linked. And we have seen over 90% rates of suppliers invited to join those programs, who do join those programs. And that's really because at the moment, I think we're focusing on incentives, so kind of no penalties related to an ESG score, but rather here's the market rate you're receiving now. If you improve or if you reach this level in ESG scoring, then here is the benefit that you will receive. And that's been a real way to help us drive this kind of program out into the market. Obviously, looking further along into the future, we do see the possibility of applying disincentives through this type of program. But for now, we're very much focused on only pushing suppliers to improve and to at least start that transparency process of obtaining a rating and then sharing it. And that's really what we're focused on.
Thank you, Alex. Arina, literally 20 seconds.
The two trends that we see is going to shape the next 12 months would definitely be not just companies facing ESG by themselves as a company because banks are asking, customers are asking. So by no choice, they have to start having a certain strategy on prioritization. And everyone's getting on that scrutiny because of central bank, Bank Negara push. All banks are asking the same question. So that's one. But the second part is when it comes to the sustainable supply chain financing, it actually provides very rich data on which helps the financial institutions to now strategize and understand where the risks and the resilience are. For example, when you talk about emissions of portfolio, that's where if a carbon taxonomy were to kick in Malaysia or the region, there are already a certain sets of data that can be stress tested to support the supply chain within the sector to decarbonize faster so that they reduce the risk and they don't have potential stranded assets or they will not suddenly face emerging threats to business continuity. So definitely from a higher level financial system or a banking as a group perspective, as what Dafina has mentioned, there is a need to understand that if the SMEs are not plugged in to be actually, to build the awareness and their resilience are not protected, the whole financial ecosystem or the value chain may break down, as what we've seen in some sectors. And what you see is the devaluation for certain part of the value chain will happen, and that directly affect the banks. The one very simple one that I say would be emerging are to look at is the automotive sector, because Singapore has already banned ICE vehicle 2040. Now that's just a starting point in the region. So if there is—
Thanks, Arina.
Yeah.
Thanks, Arina. Sorry to cut you off, but I think we're just a little bit over time. So I'm getting the nudge from the organizers. But I mean, I think it's fantastic sharing, right? So what is incredible is that, yes, there are challenges along the way, but we see the immense support coming from third-party providers, data providers, banks, as well as organizations and experts like yourself, Arina, to really support the ecosystem, to make sustainability possible in supply chain. So thank you all. Thank you, wonderful participants, for participating. I'll now pass on to Navina to actually do a quick poll on the event.
Thank you so much. Thanks a lot, Arina, Ishita, Dafina, Jalil, and Alex. This was great. And I think just listening to this, we've already decided that we must do more engagement on the area of sustainable supply chain financing. So ladies and gentlemen, you can look out for more of that. I'd like to thank everyone for spending your Friday afternoon with us. There is a poll as you click leave, so please do fill out the poll before you go, and have a great weekend, everyone. Thank you very much.
Thank you.
Hey guys.
Oh,
Hi.
apologies, Arina. I had to cut you off. It was great points, but we were already 5 minutes over, so.
No worries. I think it was such a good panel with Dafina, Jalil, Alex, and I think I thoroughly enjoy the conversation, and we do see a number of the local banks are getting on the bandwagon. So definitely, I think Dafina, Jalil, Alex, you guys set the path and have been an eye-opener to quite a number of them.
Yeah.
It needs to be an ecosystem. It can't be individually one or two banks
Exactly.
or to lead the front, right? It needs to be a total ecosystem.
Yeah,
Right.
but I think from what we see, other sustainable structures like sustainable linked loans, green loans, green trade financing, they're more easier to be adopted by the clients that we speak to. But a supply chain program in this market, it still requires a lot of awareness. Unlike countries like in Singapore, or in all the cases that I've seen from Jalil and Alex, they're all mostly from Europe, right? I mean, in Malaysia, we just did a program for one of the GLCs here in Malaysia. It's a supply chain financing program. They have clear, sustainability commitments, but to tie them together, it's like that will be a different topic or discussion. Maybe we can move towards that but even getting a supply chain financing program, when we talk to clients where you can optimize your working capital, by extending your DPO, and that will be optimal for any large buyers operating today. It's already a challenge, right? And what I see, another thing is that a lot of the Malaysian companies, the first thing they ask is, what's in it for me? What is the pricing benefit? What is the incentive? So supposedly SSCF is supposed to help because they should be getting better pricing if they do have those targets set, right? But unfortunately, the market is still very much, what's the rate like? That's why BNM, they launched a low carbon transition facility for the SMEs. They acknowledged that for banks to really support SMEs, it has been a challenge. So BNM launched in February this year, the low carbon transition is to support SMEs transitioning towards ESG and to cover any of their overhead costs, getting third-party certification and so forth. But it has been very not that encouraging. So even with the regulators pushing it and FIs wanting to jump into it, and we've got all the solutions ready, but this is where the market is. So I think to the point that a few of you made on awareness, it's still something that we just have to continuously do, right?
Yeah.
Sorry, guys. Just
and I think we did well on that today because I represent, I would say, the supply chain side of things. And you're right, awareness remains a challenge. And I think the point that Jalil, you made, and I think Dafina, you supported later, on how it impacts long-term capital deployment is a key point, which many times is out of the mandate of a supply chain professional by itself. So I think it's that change in the way companies and organizations look at it that's critical, which has happened in Europe. And we are trying our best as EY to try to do it in APAC as well.
That's my question on the due diligence. I thought that was a very good question, because one of the hypotheses that I have is that I think suppliers particularly may have the view that joining into a supply chain program, it's up here kind of situation.
Correct.
You never qualify. Sometimes I get questioned that, even from suppliers, do I need to open a bank account, etc.? So I feel there's a lot of
inertia there.
101.
Inertia there. Yeah.
Right.
I think we've been working with UNGC Feroz team to actually drive the SME conversation, having a one whole week workshops, and he's working on a handful before they scale as well. So I do see the private public partnerships, together with the regulators, will help to shape that transition faster. But you're right, Dafina. I think the key question on the floor is that 1 billion is too small. Second is the interest rate, I think, is still high. So that 1 billion SME financing can't really push unless it's attractive enough